I'm Ryan Graham, Manager of Treasury at First Calgary Financial, and this is your monthly economic update. News last week that Russia had signed a massive deal with China to supply an estimated $400 billion worth of natural gas over the next 3 decades rang loudly through the world energy markets and raised some interesting questions about Canada's future as a global exporter of natural gas. The signing finally put to rest almost a decade of failed attempts to negotiate an energy agreement between the two world's powers and promised not only to hasten development of massive fields in eastern Siberia, but speed construction of some 4,000 kilometers of pipeline needed to transport the natural gas supply to China. For Russia, this is a win-win proposition in that it not only allows the country to sell more of its energy products to a close neighbor, but also represents somewhat of a coup for President Vladimir Putin. Mr. Putin has been keenly interested in showing Europe that they cannot successfully put the economic squeeze on Russia in the aftermath of the political tensions in the Ukraine. The move to isolate Russia may actually end up backfiring on the Europeans, who must surely harbor fears that future supplies of natural gas could either be curtailed or outright revoked, with little damage to the resource revenue-dependent Russian economy. As for China, it not only benefits by acquiring a long-term supply of natural gas at a fixed price, some 38 billion cubic meters of natural gas per year at an estimated $10 US per million cubic feet, but also gains greater leverage to secure better pricing deals with Canadian and other natural gas exporters looking to capture a piece of the lucrative Asian energy market. This is no mean feat, considering the International Energy Agency is projecting that China's natural gas demand will rise by at least 6% per year through 2035. Russian natural gas is expected to start flowing into China in about 4 to 6 years, but it is not likely to stop the Chinese from looking to other producers to diversify their supplies, especially given that Russia has in the past and probably will continue in the future to use its energy supplies as a political tool. The question now facing Canada, with its ambitious plans to become a major global exporter of natural gas, is how does the country achieve its dreams in the face of suddenly intensifying global competition that promises delivery on a schedule much quicker than most Canadian natural gas export projects can be developed? It's quite likely there will be no shortage of customers in the future, given that the large-scale natural gas importers in Asia include not only China, but Japan, India, and South Korea. However, the problem is likely to be in the price. There are even rumors that the large natural gas importing countries have formed a buyer's club on price, aiming to keep the price of the commodity as low as possible. More and more countries are taking advantage of lower spot prices or favorable long-term deals at prices that are not only serving to weed out some of the marginal projects, but may actually start to plumb the levels that make some major North American natural gas projects downright uneconomical. Canada's west coast, considered to be sitting on a vast ocean of energy, is still betting heavily that large natural gas importers will want to have a reliable, read not Russian, source of new supply that would not be imperiled by politics, and they feel they fit the bill to a T. But if lack of current distribution facilities and a downwards price trend are not enough of an impediment, the oil and gas companies may be faced with a liquefied natural gas tax of up to 7% proposed by BC's provincial government. In fact, several companies are looking for clarification from the provincial government on the proposed tax regime before making final investment decisions. We can only hope that Canada doesn't shoot itself in the foot, as all the various vested interests line up to take advantage of the hoped-for natural gas bonanza.